How to invest in real estate from scratch. Step 1. Understanding the basics. Let's kick things off with a story. Imagine two friends. Alex, who thinks real estate investing is just buying any house and waiting for the money to roll in, and Jamie, who's all about the nitty-gritty, market analysis, investment strategies, the works. Who do you think ends up on top? Spoiler. It's not about luck. It's about knowledge. Investing myths can derail even the most enthusiastic beginner. That's why understanding the basics can set you on the right path from day one. Let's debunk some common myths and uncover the facts about real estate investing. Myth 1. Real estate investing is only for the wealthy. Fact. While having ample capital can certainly be advantageous, there are numerous ways to start investing in real estate with minimal funds. Strategies like house hacking, crowdfunding, and real estate investment trust or REITs make it accessible to a wider range of investors. Myth 2. Real estate investing is passive income. Fact. While real estate can generate passive income, it requires active involvement, especially in the beginning stages. Successful investors dedicate time to property management, market research, and financial analysis to maximize returns. Myth 3. It's always better to invest locally. Fact. While investing in your local market may seem convenient, it's not always the most profitable option. Savvy investors recognize the value of diversifying their portfolio by exploring opportunities in different markets, both domestic and international. Myth 4. Flipping houses guarantees quick profits. Fact. House flipping can be lucrative, but it's not without risks. Unexpected expenses, market fluctuations, and renovation delays can eat into profits. Successful flippers conduct thorough research, budget meticulously, and have a solid exit strategy in place. Myth 5. Real estate always appreciates in value. Fact. While real estate has historically appreciated over time, it's not immune to market downturns. Local economic factors, supply and demand dynamics, and neighborhood trends all play a role in property value fluctuations. Step 2. Setting your goals and budget. Picture this. You're setting sail on the vast ocean of real estate. Your goals are your compass, your budget, your map. Let's dive into a real-life example. Meet Taylor, who started with a single rental property and grew a portfolio that allowed them to retire at 40. How? Clear goals and smart budgeting. Let's break down the main components of a good budget. First, there are the obvious expenses like mortgage payments, property taxes, and insurance premiums. But wait, there's more. Don't forget about maintenance costs, which can sneak up on you if you're not prepared. From routine repairs to unexpected emergencies, setting aside a portion of your rental income for upkeep is essential. Then, there are property management fees if you opt for professional management services. It's crucial to account for vacancies too, periods where your property may sit unoccupied, still incurring expenses but generating no income. And let's not overlook the importance of budgeting for unexpected expenses like major repairs or legal fees. Building a buffer into your budget can save you from financial headaches down the road. And remember, it's not just the price tag of the property. Closing costs, property taxes, and maintenance can add up. Don't let unexpected expenses sink your ship. Step 3. Market research and finding the right property. Now let's play detective. Market research isn't just about location. It's about timing, trends, and tales of the city. Here are some key signs of emerging neighborhoods and investment opportunities. Gentrification indicators. Influx of young professionals, new businesses, and improving infrastructure. Revitalization projects or government initiatives. Strong job growth and low unemployment rates. Increasing property values. Demographic shifts and lifestyle preferences favoring urban living. Proximity to amenities like parks, restaurants, and public transportation. Insights from local real estate agents, developers, and community members. Here's a tip. Look for areas with new infrastructure projects, improving schools, or growing job markets. These are gold mines waiting to be discovered. And when scouting properties, think like a tenant or buyer. What would you look for? A quiet street? Proximity to amenities? Always keep your end user in mind. Step 4. Financing your investment. Let's talk turkey. How do you fund your investment dream? Meet Jordan, who used a mix of savings and a loan to buy their first duplex. And then there's Pat, who teamed up with friends to buy a small apartment building. Financing is where creativity meets reality. Ever heard of house hacking? Or using a home equity line of credit? There are myriad ways to get your foot in the door, literally and figuratively. Step 5. Making the deal and beyond. You found the perfect property. Now the dance begins. Negotiation isn't just about price. It's about terms, conditions, and sometimes who blinks first. And after the deal, the adventure continues. Effective property management can make or break your investment. Let's talk about maximizing occupancy, dealing with repairs, and the secret sauce. Happy tenants. Scaling your portfolio is next. Once you've got one property under your belt, the next becomes easier. It's about leveraging your experience, learning from your mistakes, and not being afraid to take calculated risks. If you've enjoyed this deep dive into real estate investing, smash that like button, share with your fellow investors, and subscribe for more insider tips. Got questions? Drop them in the comments below or share your own success stories. We're all in this journey together, building not just wealth, but communities and legacies.